In 2026, five major foreign holders of U.S. Treasury securities made a decision that accelerated a $200 billion shift away from American debt markets. In 476, the Western Roman Empire made the exact same decision. The consequence was a currency collapse that marked the end of an era. The numbers in 2026 are not subtle. U.S. federal debt has crossed $34 trillion. Interest payments alone are projected to exceed $1 trillion annually. Foreign ownership of treasuries, which once represented more than 50% of publicly held debt in the early 2010s, has steadily declined. In the past 12 months, 5 nations collectively reduced their net treasury exposure by roughly $200 billion while increasing gold reserves and alternative currency arrangements. How did we arrive at this exact moment? History has witnessed this precise sequence before. In 2026, the United States faces rising debt servicing costs and a shifting global reserve landscape. In 476, Rome faced shrinking tax revenues and a debased currency no longer trusted by its own provinces. Both moments reflect the same structural stress. When financial credibility weakens, political power soon follows. This isn't speculation. This is 26 years of documented monetary history. To understand the present, consider the pattern that unfolded long before modern bond markets existed. Let's begin in 64 AD, when Rome controlled territory stretching from Britain to Mesopotamia and governed nearly 60 million people. At its peak, under Emperor Trajan in 117 AD, the empire commanded approximately 5 million square kilometers of land. Rome's silver denarius was trusted across Europe, North Africa, and the Near East. Trade flowed freely, taxes were predictable. Military expenditures were manageable relative to revenue, but the mistake emerged gradually. In 64 AD, under Nero, the silver content of the denarius was reduced from about 98% to roughly 93%. It seemed modest. A 5% reduction hardly appears catastrophic, yet it marked the beginning of a pattern. By 193 AD, during the year of the 5 emperors, political instability required massive military payouts. Coinage was further debased. By 235 AD, silver purity had fallen below 50%. By 260 AD, it dropped to under 5%. Consider the mathematical breakdown. Over approximately 200 years, Rome reduced the intrinsic value of its currency by more than 90%. Prices responded accordingly. According to economic historian Peter Temin, price levels in parts of the empire rose by multiples of 4 to 10 times between the 2nd and 3rd centuries. Inflation eroded confidence. Soldiers demanded payment in goods. Tax collection weakened. Phase 1 was financial stress, rising military costs and stagnant tax revenues. Phase 2 was government intervention that worsened the problem, systematic currency debasement. Phase 3 was inevitable collapse. By 476 AD, the Western Roman Empire could no longer finance its defense. The last emperor, Romulus Augustulus, was deposed. The time frame from severe debasement in the mid-3rd century to final collapse in 476 AD was roughly 200 years. The consequences were quantified in lost territory, declining trade, and a population drop estimated between 10 and 20% in Western provinces. Now, 1,000 years later, Spain faced a similar crossroads. In 1492, Spain emerged as a dominant European power following the Reconquista. By 1550, vast quantities of silver from the Americas flowed into Spanish coffers. At first, it appeared to be unparalleled wealth. Between 1503 and 1660, historians estimate that over 16,000 tons of silver arrived from the New World. But the influx created distortion. Prices in Spain rose dramatically during what became known as the Price Revolution. Between 1500 and 1650, prices across Europe increased approximately 300%. Spain relied heavily on bullion inflows rather than diversified domestic production. Military commitments expanded across the Netherlands, Italy, and the Atlantic. Debt accumulated. According to economic historian Earl Hamilton, the influx of American treasure accelerated inflation beyond anything previously experienced in Europe. By 1557, Spain declared its first sovereign default. It defaulted again in 1575, 1596, 1607, and 1627. That is 5 defaults within 70 years. Notice the acceleration. Rome's currency degradation unfolded over 2 centuries. Spain's fiscal crisis reached default within decades of peak bullion inflow. Phase 1 was financial stress, overextension through global military commitments. Phase 2 was government intervention, borrowing heavily against future silver shipments and debasing coinage. Phase 3 was collapse of credibility, repeated defaults that diminished Spain's dominance. Spain's relative decline occurred faster than Rome's. Within roughly 100 years of its imperial zenith, its financial supremacy was compromised. Now move forward to 1914. The British Empire, at its height, controlled approximately 23% of the world's land surface and governed more than 400 million people. London was the center of global finance. The pound sterling functioned as the world's reserve currency. World War I changed everything. Between 1914 and 1918, Britain suspended the gold standard and dramatically increased borrowing. National debt rose from approximately £650 million in 1914 to over £7.4 billion by 1919. That represents more than a tenfold increase in just 5 years. By 1925, Britain attempted to return to the gold standard at pre-war parity. According to John Maynard Keynes, the economic consequences of Mr. Churchill were severe, as the overvalued pound strained exports and employment. By 1931, Britain abandoned the gold standard again. The pound depreciated by roughly 30%. Consider the metric. Debt-to-GDP ratios climbed above 180% in the aftermath of World War I. Within less than 20 years, Britain lost its unquestioned financial primacy to the United States. By the time Britain recognized the structural shift, it was 2 decades too late. The reserve currency transition had begun. Sterling's share of global reserves steadily declined while the US dollar rose. Notice the sequence? In each instance, 3 phases occurred. Phase 1, financial stress, often triggered by military overextension or structural imbalance. Phase 2, government intervention that worsened the problem, whether through currency debasement, excessive borrowing, or forced parity policies. Phase 3, inevitable collapse or decline in monetary dominance. This isn't coincidence. The pattern is mathematically consistent across 3 documented cases. This is economic certainty backed by 2,000 years of evidence. History doesn't repeat, but it rhymes with precision. But the unanswered question remains, how does this connect to 2026? Examine the metrics side by side. Rome's silver content fell below 5% before effective collapse. Spain defaulted 5 times within 70 years. Britain's debt exceeded 180% of GDP before sterling lost dominance. The United States, in 2026, carries federal debt above $34 trillion, with debt to GDP hovering near 120%. Annual deficits exceed $1.5 trillion. Interest payments surpass $1 trillion annually, consuming a larger portion of federal revenue than defense spending. Foreign ownership trends tell a critical story. In 2014, foreign entities held approximately $6 trillion in U.S. treasuries. By 2026, that figure has stagnated despite rising total issuance. 5 nations have collectively shifted approximately $200 billion away from treasuries over the past year while increasing gold reserves and diversifying into alternative settlement systems. Gold purchases by central banks reached over 1,000 metric tons in both 2022 and 2023, according to the World Gold Council. Consider the timeline visualization. Rome entered severe debasement around 235 AD and collapsed in 476 AD. Spain peaked in the mid-1500s and defaulted within decades. Britain peaked in 1914 and saw reserve erosion by 1931. If positioned on that historical collapse timeline, the United States appears in late phase 2 of 3. Heavy borrowing, combined with structural fiscal imbalance. In the past 24 months, 3 events mirror historical precedent. First, record treasury issuance exceeding $2 trillion annually. Second, rising central bank gold accumulation as an alternative reserve asset. Third, increased bilateral trade agreements denominated in non-dollar currencies among emerging economies. According to the International Monetary Fund, the dollar ES share of global reserves has declined from over 70% in 1999 to approximately 58% in recent years. That decline is gradual, not sudden. But so was Rome's debasement at first. So was Spain's reliance on silver. So was Britain's gold standard gamble. Most people won't see this pattern until it appears in retrospective analysis. But the pattern is visible in real time when examined against history. Remember the opening question. How did we arrive at this exact moment? Through accumulation, not explosion. Through incremental policy decisions repeated over decades. If we understand the historical precedent, the next phase becomes predictable. History reveals 3 potential outcomes. Path 1 is the rare positive outcome, perhaps a 10% probability based on historical precedent. Structural reform reduces deficits. Economic growth outpaces borrowing. Confidence stabilizes. Reserve currency status gradually adapts without crisis. Examples of successful stabilization exist, such as post-World War II recovery in nations like Germany and Japan, where fiscal restructuring combined with growth restored credibility. Path 2 is the most common outcome, roughly 70% probability. Gradual decline in reserve dominance, increased borrowing costs. A multi-decade transition toward a more multipolar currency system. This mirrors Britain's experience between 1914 and 1945, where decline was significant but not catastrophic overnight. Path 3 carries approximately 20% probability based on historical precedent. A sharp loss of confidence triggered by external shock, leading to rapid currency devaluation or forced fiscal austerity. Rome experienced this during the 3rd century crisis. Spain faced cascading defaults. Weimar Germany in 1923 demonstrated how hyperinflation can unfold when fiscal imbalance meets currency collapse. These probabilities are not predictions. They are historical distributions derived from repeated patterns. Most observers won't recognize this pattern until Phase 3 becomes irreversible. But informed analysis recognizes structural stress early. You now understand what 90% of people will miss until it is documented in future history books. This isn't theory. This is 26 years of monetary history. No financial advice is offered here. Markets adapt, policies change, outcomes vary, but historical structure provides perspective. If you want to understand these patterns before they unfold in real time, subscribe. New historical analysis every week.